Hi, this is Jason, Chief Technical Analyst with Toro Alerts, with your weekly market recap for the week ending October 28th. We had a pretty strong week in the markets across both traditional markets and the crypto asset classes. So let's dive into the charts and take a look at what we're seeing. Starting out with the Bitcoin chart, we're closing the week out, looks like just about 20,500 or so on Bitcoin, and we've had a pretty big move on the week. We started out closer to about 19K or so, and we've had a pretty nice move to the upside on Bitcoin. We've also seen that correlate with a dollar weakening, and so as long as the dollar continues to consolidate, or at least at a minimum stop going up, which it looks like it's doing right now, then we could be set up with a nice trade opportunity for some crypto trades. I'm currently in Ethereum and a couple altcoins. I'm actually trading Mara, the crypto miner, for some exposure to Bitcoin with a bit more leverage involved to the upside on that. But currently we're looking at a Bitcoin price, like I said, just about 20,000, about 20,500, sitting at 20,600 currently. It looks like we've got some more upside possibilities on the crypto space. The next potential resistance area we might be looking at would be about 22.5, and if we can get above those levels, then we'll be seeing if we can get up to about 25K once again, which is about where we topped off after the June rally that we had a few months back. And so things are looking fairly bullish, at least in the short term, for the crypto space. And taking a look at the Ethereum chart, similar story here. We were trading around in a range for Ethereum between about 1225 and 1400. So as soon as we broke that range, I got into the trade just above 1400 and looking for some upside opportunity in Ethereum as well. We are up above about the 1550 level, which was an area of potential resistance, and it looks like we are trying to push above that currently. Next resistance level we'll be watching for on Ethereum would be that 200-day moving average. And if we can break above that, then we'll see if we can get back up to at least the highs from the June lows, which would put us back up to about 2K or so on Ethereum. That really will come down to the dollar and how that responds, as crypto markets, including the stock market, but crypto even more so, tends to have a very strong inverse correlation to the dollar price action. So let's go ahead and dive over to the dollar chart and take a look at that at our DXY. We can see these are daily candlesticks, and so we can see that we've had a pretty strong downtrend for a while now. We peaked out in the dollar back in looks like September 28th, and since then we've had a pretty steady decline. Got all the way back down to below 110, and then we did see a brief rally, but then it rolled right back over. So as long as we kind of stay below this trend line here, which right now would probably be about 113 or so on the DXY. As we get a little bit further in time, that number will obviously decrease, as we've got a descending channel here that we're watching. But so far it looks like we might be a wave 4 of a wave 5 to complete on the dollar. A lot of people talking about maybe the dollar has peaked and is going to roll over from here. I think there's still a little bit more upside in the dollar potentially, and so I don't think we have seen a final top in the dollar, but it does look like we've got some good consolidation happening right now. And on the dollar, some of the downside targets I'll be looking for, the first one was that 109.70 level, which we touched and then bounced off of that the last couple of days, but we did get rejected off the 50-day moving average on this on the DXY chart, and so we'll be seeing if we roll over further going into next week, which would support further rallies in the market and the crypto space. If we do head below that 109.70 level, the next downside target I'll be watching on the DXY is about 108, and then we could potentially see a retracement on the DXY all the way down to about 106.50. That would be a 61% retracement, which would make a lot of sense since our wave 2 decline we had was fairly small. And so using Elliott wave theory, anytime our wave 2 is a small decline, typically the wave 4 is a bigger decline. And so that could set us up for a decent little rally in both crypto and the markets if we see the dollar continue to kind of at least stall out, if not continue to decline further. But I do think we have a little bit more upside left in the dollar, and that'll likely coincide with some selling in the markets. But right now things are looking pretty good with that dollar index, and that's making me pretty bullish, along with many other factors that we'll get into. But that dollar index has been one of the most important charts in the market from a macro perspective, and I think the dollar continues to correct, setting us up for a rally going into the end of the year. let's dive into the S&P 500 chart, or SPY. We got all the way up to about 390, finishing out the week. That is a pretty major, important area of support and resistance, and so we're going to need to see how we react going into Monday. Wouldn't surprise me if we did see a bit of a correction and a sell-off off of that 390 level, as that has been a pretty major area of support and resistance. But if we do get back above 390, then that would also be a pretty solid support floor to kind of watch for. We can also see that in the S&P 500, off this sell-off that we've seen really for the entire calendar year of 2022, we've had basically a steady decline, but we also have had some rallies throughout that. And if we look at some of the other previous rallies that we had, a lot of those ultimately failed at that 61% retracement level, which would put the SPY right at about 400. But I think there's actually a decent chance we could push further than that. If we zoom out on the S&P 500, we can see that we've got what looks like potentially a 5-wave structure to the upside from the COVID lows, and what looks like we might be seeing is a wave 4 that's completed to the downside, and then that would set us up for a 5th wave to the upside. And if that happens, then I think there's a good chance that we at least retest the top of this channel here, which would get it a little bit higher than that 400 level most likely. And then there's even a chance that we rally further from there. It's really going to come down to the Fed positioning and how the FOMC meeting goes next week and over the next month or two. But if the dollar continues to stall out and the Fed isn't raising rates further above what's expected, then I think we are set up for potentially a decent end of the year rally, and we're certainly positioned long right now, looking for some upside opportunities. But I do think there still is more pain in the markets to come in the future. But right now things are looking fairly bullish in the short term. And then when we take a look at some breadth measures and the SPX, we can see that we've got about 22% of stocks in the S&P 500 above the 200-day moving average, and we can also see that we're sitting at about 33%, almost 34% of stocks in the S&P 500 above their 50-day moving average. And so while that's still fairly low, that's a big improvement off of where we were just at the beginning of October. So just a month ago, we were sitting below 10% of stocks above the S&P, or above their 50-day moving averages, and we were sitting at right at about 10 or 11% of stocks just above their 200-day moving average. And so both of those were significantly worse a month ago. So we've seen some big breadth improvement in the S&P 500. And then take a look at our Nasdaq. Nasdaq's been struggling a little bit more than most areas of the market, but we did see a big rally on Friday, closing out the week. We did get up to this Fibonacci extension level, which is sitting at about 282.23, and that so far is acting as resistance. So we'll need to see how the market reacts on the Nasdaq going into next week. That's also right around an anchored VWAP position, which is right about almost the exact same level. So that's a fairly significant support and resistance area. So we'll need to see if it can get above that. If it does, that'll act as a pretty nice floor. We also have that 50-day moving average coinciding right around that same area. So I think we'll get some good indication where the Nasdaq's heading next week. If we see some price action break above that Fibonacci extension, the VWAP, as well as the 50-day, then they're going to continue to see some more bull momentum in the technology space and in Nasdaq. But if we do see it fail off those levels, then that's likely not a good sign for our technology sector. And we saw a lot of reporting in large cap tech this week. Many of them struggled, a few of them did okay, and so it's still kind of a bit uncertain. And as we're going to dive into shortly, looking at growth versus value, we'll be able to see in the chart there that value is still the strong outperformer over technology right now. And so if there is a sector that I'm a little bit more cautious on in the markets currently, it is the technology space and a lot of the Nasdaq stocks that have been the relative weakest performers in the market as of late. And then when we jump over to the Dow Jones Industrial Average, we can see that we actually got back above the 200-day moving average on the Dow Jones Industrial Average, which I think is a pretty significant development. We did get briefly above it off that June rally, and then ultimately failed off and sold off pretty aggressively. And we can see that we're also kind of on a trend line right around where the June rally finished as well, and so we'll want to see if we can see some continued upward movement in the Dow Jones Industrial Average from these levels. If we do, then I think that would be pretty bullish for the markets in general, as Dow theory tends to lead the markets, and if we continue to see that upside momentum in the Dow Jones Industrial Averages, that'll certainly look pretty bullish, I think, for the broader markets in general. And when we look at the growth versus value chart here, when we've got value outperforming, we've got this chart going down and to the right, and when we have growth outperforming, we've got this chart going up and to the right. And so right now we can see that overall for most of the year the trend has been value, as this chart has been going down on a consistent basis. We did see at that June rally where growth started to outperform in that period, but then we did see value overtake growth, and then now we've seen a rally over the last few weeks in the markets, but we're actually not seeing the rotation back into growth outperforming value. And so it's looking like, so far at least on this rally, that value is a much safer place to be than growth currently. And when we take a look at our Dow Jones Transportation Index, or DJT, saw a big rally on this one. This is our weekly candlesticks. Held support last week, and actually 2 weeks in a row now, at this anchored VWAP position, which was about 12,400. Held support there, and then we saw a big rally this week in the transports. Also a part of the Dow theory, transportation is an important sector, because obviously that's how everything gets moved around, and so if the economy's falling apart, then typically transportation's not doing well, and so this is, at least on the week, has been a very strong week for transportation, and so we'll take a look at that closely going into the following upcoming weeks to see if this rally likely has legs. We'll most likely continue to see the transports move to the upside as well. And then take a look at our Russel 3000 chart. This is a trendline channel that has been in place since the Great Financial Crisis, and so this has been a pretty major chart, from at least from a macro perspective, a market perspective, to keep a close eye on, as this is tracking 3,000 different stocks in the market, and this has got a lot of data to kind of go off of. We've only fallen outside of this chart during the COVID crash to the downside, and so this has been an extremely reliable chart to kind of watch as far as market health. And we did get below that 200-week moving average briefly a couple weeks ago when we put that bottom in the markets, and then we've had a pretty strong rally the last couple of weeks. We're now sitting at the 150-week moving average, which could act as resistance, and so we could potentially see a rollover from here, at least in the short term, but I do think this rally has a little bit more legs to go. And so if we see it push up above that 150-day moving average, then we'd be looking for that center channel as potential resistance, which currently is sitting right around about 2,400 or so on the Russell 3000. When we take a look at large caps, our IWB also had a big rally the last couple of weeks after we put in the bottom in the markets about 3 weeks ago, and now we're sitting at the 150-week moving average in large caps as well, so we'll want to keep an eye on that going into next week to see if that acts as resistance, and if large caps roll over. We have seen small caps outperforming large caps recently, and we'll dive into those charts. And let's jump over to the small caps. We can see a big rally in small caps this week, and we are coming up against what could be potential resistance on our anchored VWAP position from the COVID lows, which is sitting at about 187 or so on the IWM. We'll see if we can get above that. If we do, that would look continue to look even more bullish for small caps. And when we take a look at small caps relative to large caps, that we can see in this chart here that small caps have been outperforming on a relative basis over large caps really since about the beginning of May or so. So it's been not a massive uptrend, but it has been a fairly steady uptrend where small caps are outperforming our large caps for the last few months. And then taking a look at our sectors that we track, seeing some of the strongest performers and our weakest performers on the trading week. So this is for just this last trading week in the markets. We can see the ARK Innovation and Fintech in our leaderboard at the top with about 8% of upside both. We can see the retail and Homebuilders are up over 7%, and then the industrial sector, solar sector, utilities all up about 6+% as well. And then towards the bottom of our sector review, we can see that steel is sitting at the bottom, down 4%, over 4% on the week. Emerging markets still relatively underperforming compared to the rest of the market. We can also see communication services is down about 2%, as well as the ag fund down about 2% on the week. And then lithium, the other sector that's down almost 2%, about 1.5% down on lithium. But we can see a lot of green this week. Most of the major industry groups are up on the week, and even most of our subsector industry groups that we track are all looking pretty positive on the week. And then taking a look at our U.S. oil chart, we can see that we ultimately held that $85 level as support the last couple of weeks. That was a pretty important level, I think. If we were going to continue to see some further sell-off in oil, we'd likely see a close below that $85 level, but it's held support the last couple of weeks, which is looking pretty bullish, and we actually had a decent move to the upside on the week, closing out just above $88 per barrel. And energy has looked pretty strong as well on a relative basis, taking a look at different sector strengths, and I think there's actually going to be a really nice energy trade. Once again, we had a really nice energy trade for most of the year. In fact, it was really one of the only sectors in the market that had a really strong performance throughout most of the year, but then we obviously had a massive sell-off in the oil prices that started back in June of this year, and that ultimately created some weakness in the energy space. We didn't see a massive sell-off in it on stock prices, but we did see some corrective price action in the energy sector, and I think that's likely completed. And so I think this could be a very good short-term bottom to get back into some energy trades. I've got quite a few energy trades that I already have put on, and I think there's going to be some big upside momentum in the energy trade space over the next few months, and a great place to be looking for some upside opportunity. And then we take a look at our CRB index, our commodities. We did have a move to the upside on the week, but we ultimately failed off that 50-week moving average, and most of those gains were given back on the week, ultimately closing on the CRB index just below 273. And as long as we are sitting below this down channel trend line as well as that 50-week moving average, then I think the bias has got to be lower on the commodity space. If we're looking for a short opportunity in commodities broadly, I want to see some price action close below that 267 level, and that could ultimately set us up for a decent short all the way down to about 243 on the CRB index. But for now, things are looking good, I think, at least from the inflation narrative standpoint. If commodities are continuing to go down, that's going to help our inflation numbers. But right now, I don't see any obvious trades necessarily to the upside or downside in the commodity space, as we're kind of still sitting in this neutral zone area. I want to get below that 267 level if we're looking for a short opportunity. And hopefully commodities do go down, because that's obviously the goal of the Fed. They're trying to beat inflation, and so we really do want to see the CRB index continue to decline for just the overall positivity and health of the market. And then taking a look at our VEU, which is our all-world index minus the United States. So this is our global markets minus the U.S., and we did put in a bottom at this 44 level 3 weeks ago that we talked about. It's a pretty strong support area, and it looks like that's been holding pretty well so far. I think on relative terms, the United States has still been the better place to be. Anytime you've got a rising dollar environment, even though we have seen a pause in the dollar recently, it's pretty hard, I think, to trade a lot of these emerging markets when you've got a strong dollar. But so far, as long as we're above that 44 level, then this global ETF looks like a pretty strong floor at that $44 level, at least for now. But we can also see that we're still in a pretty strong downtrend that has not been broken really since the decline started, going all the way back into the late part of 2021. And then we got our high yield corporate bond index. This has been a pretty ugly chart for quite some time, as we've been in a really strong downtrend. But we can see when the market rallied in June, we saw the HYG move to the upside, and same thing here when we put in the bottom beginning of October in the markets, then we started to see HYG rally to the upside. So the HYG is a really strong chart to watch for overall market health. Typically when HYG is going down, the markets are in trouble, and vice versa when they're going up. We usually have some sort of rally associated with that. So the HYG chart is supporting this rally right now, and it looks like we've had a pretty big move to the upside on the week in the HYG chart. And so at least in the short term, things are looking pretty good, and I think there's a decent chance that this rally could continue a bit further still. And then taking a look at our gold chart, looking at our precious metals, we're still seeing a downtrend in gold. We're below the 200-week moving average, and also have not broken out of this down channel trend line. I think gold might be set up for a decent trade going into 2023. But ultimately what I want to see is at least a pause in the Fed interest rate increases, and that ultimately might be a decent signal to get back into the precious metals trade. And I also want to see price action break above this down channel trend line and ideally get back up above that 200-week moving average, which is just above some support and resistance area right around the 157 on the GLD. Similar story with silver. We're also below the 200-week moving average, kind of in a down channel trend line still, so we'd want to see it break above these declining prices. We'd want to get some price action back up above that 200-week moving average, and if we do see interest rates paused at least, then that could support a gold and silver rally going into 2023. Take a look at our interest rates. Our 2 years had a spike last week, ultimately sold off, and then this week we sold off a bit further, but a lot of those decreases ultimately popped back up. Closed the week out on our 2 year at about 4.424%, and I think the market's ultimately kind of doing this back and forth motion and price action on interest rates, kind of waiting for that FOMC meeting next week to see what the Fed says going into the next potential rate hike cycle. I think the market's expecting about a 75 basis point increase from the Fed next week, and I think we'll likely get some definitive price action in our interest rates on these charts here from that 4.5% level. So if we see a big move to the upside off of that, our next upside target on the 2 year would be that 5% level. And then taking a look at our 10-year rates, we peaked out right around 4.25% or so, and ultimately sold off this week and gave up all the gains from the previous week, but then found support just above 4%. And so I think similarly we're seeing all these charts having some upside and downside volatility over the last couple of weeks, but ultimately settling down in pretty similar ranges over the last couple of weeks. And I think that's just the interest rates kind of waiting on the next Fed decision, which is coming up next week as we discussed, and I think that'll ultimately drive where the interest rates head from here. But right now I think there's a decent chance we do hold that 4% level, at least in the short term. If we see some consistent price action on the 10-year below that 4% range, then that might signal the potential end of the increase in rates on our 10-year, but we need to see how things shake out with those Fed meetings coming up next week, as well as going into December. But I think there's a lot of people anticipating that we're at least getting potentially close to a possible pause in some of the rate increases. Then our 30-year moved up all the way up to almost 4.5% last week, and then this week sold off, ultimately closing down at about 4.15%. Take a look at our VIX. We had a big decline on the VIX really for the last couple of weeks. Just a few weeks ago, back in, looks like it was October 12th, we were sitting at almost 35 on the VIX, and we've seen nothing but a steady decline from here. Ultimately, the VIX is now down below the 200-day moving average and fast approaching that 25 level, so we'll see going into next week if we continue to see the VIX fall further below that 25 level. I think that'll just continue to be a strong indicator that the market's likely head higher, but we obviously can see the markets head higher at this elevated volatility level as well, because while the VIX has been declining and still trading in this 25 to 35 range, we've seen a pretty decent rally over the last couple of weeks. And then take a look at our put call ratio. We've seen a lot of days where the put call ratio has been elevated above that 1%, which is ultimately elevated put buying protection, and we got back above there yesterday when the market sold off a little bit on Thursday. I think that's showing that people still have quite a bit of fear in the markets, and anytime you do get a bit of a sell-off, people immediately get defensive. But ultimately on Friday we had that huge rally, and then that put the put call ratio back below the 1 range, which is ultimately a more normalized put call ratio. And so not a bunch of massive defensive positioning going on in the markets at the time. And then taking a look at our yield curve. So this is actually a chart with two charts on it. We've got at the top, we've got our 10-year minus our 2-year, which is one of the most popular yield curve charts that people reference. And then we also have our 10-year minus our 3-month, which is another important yield curve chart. So depending on which one you look at, they both long-term, I think, are flashing some warning signals. We've been highly negative in the 10-2s for quite some time. We went negative back in July of this year and have stayed negative this whole time. We've been at historic negative levels on the 10-2s for multiple weeks. And then now this week we saw a development where our 10-year -3 month ultimately dropped below the zero line, going negative for the first time since March of 2020 during the COVID crash. And we are now, while we ultimately closed just above the zero line on the week, we did ultimately break that line below the zero line. I think it was Wednesday or Thursday of this week, and so we need to keep an eye on that. But typically when we see that drop below zero, that's a really strong signal for a recession coming. And so no matter whether you like the 10-2 or the 10-3, both of these charts, while things are looking fairly positive in the short term, and I think we've got a decent rally in front of us on the short-term time scale, longer term, I think both of these charts are warning us that there's likely more pain in the markets in the future. So thanks for tuning in this week. Make sure to download the Toro Alerts app on the App Store. We've got one for stocks and one for crypto. Give the video a like and a share, and we will see you next time.